This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. Oil prices steadied on Friday, but fell for the week on a stronger US dollar and fears that an economic slowdown would weaken crude demand. Brent crude futures settled at $96.72 a barrel, gaining 13 cents. US West Texas Intermediate crude ended 27 cents higher at $90.77. Both benchmarks fell about 1.5% on the week. Oil briefly jumped in volatile trade on comments by Richmond Federal Reserve President Thomas Darken, who said the drive to raise rates also needs to be balanced with the impact rate hikes are having on the economy. But crude paired gains as investor concerns about upcoming rate hikes settled back in.
The European Commission approved on Friday a €27.5 billion, $27.66 billion, German scheme to help energy-intensive companies deal with higher electricity costs resulting from having to buy permits on the EU carbon market. The Commission's approval falls in line with EU rules on state aid that aim to ensure fair competition for companies in the single market of the 27-nation bloc. Energy-intensive industries have long complained that having to pay for the carbon emissions they produce through the European Union's emission trading system, ETS, the bloc's main tool for enforcing its climate policy, puts them at a disadvantage compared with non-EU industry.
Moving on to the top news in the energy sector.
The prospect of a global recession and doubts over economic stimulus in China, the world's biggest user of raw materials, add to the challenges of mining companies as they grapple with energy costs, raising the risk of downsizing and layoffs. None of the major diversified miners is under financial strain after years of strong commodity prices. But leading miners Rio Tinto, Anglo American and Antofagasta are among many to have posted a fall in half-year earnings and lowered shareholder payouts. Even those whose profits stayed high, including BHP Group and Glencore, flagged the risk sluggish commodity demand over the coming months could lower returns.
Policymakers, lawmakers and insufficient oil and gas sector investments are to blame for high energy prices, not OPEC, the producer group's new Secretary General Haytham Al-Ghais told Reuters on Thursday. A lack of investment in the oil and gas sector following a price slump sparked by COVID-19 has significantly reduced OPEC's spare production capacity and limited the group's ability to respond quickly to further potential supply disruption. The price of Brent crude came close to an all-time high of $147 a barrel in March, after Russia's ordering of troops into Ukraine exacerbated supply concerns. While prices have since declined, they are still painfully high for consumers and businesses globally.
Next, we have the top news in metal markets.
Power restrictions in China have shuttered at least 500,000 tons per year of zinc smelting capacity, consultancy CRU Group said on Friday, with production losses expected to reach 5,000 to 6,000 tons a week. China's southwestern Sichuan province ordered industrial plants to suspend production from August 15 to August 20 to prioritize residential power supply amid its worst heatwave in 60 years. All zinc smelters in Sichuan halted production early this week, and a small smelter based in neighboring Hunan province also stopped operations in the following days, said Dina Yu, a zinc and lead analyst at consultancy CRU Group.
Copper prices inched higher on Friday but were set to end the week slightly lower as traders balanced hopes for solid demand in China with pessimism about the global economy. Inflation data in Germany and Japan released on Friday and statements from European and U.S. central bankers this week suggest that rapid, economically damaging interest rate rises will continue. Investors turned cautious, pushing down global equities and driving up the U.S. dollar, pressuring dollar-priced metals by making them costlier for buyers with other currencies. We will now look at the top news in the agricultural sector. A further 10 cargo ships are being loaded with grain in Ukrainian Black Sea ports and being prepared for shipment under a food export agreement brokered last month, Ukraine's infrastructure minister Alexander Kubrakov said on Friday. Ukraine's grain exports have slumped since the start of the war because its Black Sea ports, a vital route for shipments, were closed. driving up global food prices and prompting fears of shortages in Africa and the Middle East. At the end of July, 3 Black Sea ports were unblocked under a deal between Moscow and Kyiv, brokered by the United Nations and Turkey.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.